Hey, real estate hackers, welcome back to another show. I'm going to actually walk you through the deal analyzer. This is a resource that you can download if you go down to the bottom of this video. It's a link in the bottom of most of our YouTube videos. You can download this deal analyzer for free. And all the deal analyzer does is instead of you having to do napkin math, write out the math to see if the numbers work, this is going to speed up the time that you can analyze rental properties. So it's going to allow you to analyze more rental properties and determine which ones are good deals for you and do it in an efficient fashion. So it's a little bit different video. As you see, I have you down here looking at the analyzer, looking at my screen, so I can walk you through the different number breakdowns, what they mean, and how you can fill out these analyzers to make it very efficient. So this is what it looks like. This green screen here. And just looking at the deal analyzer itself, there's a few things that I want to note for you. The categories in gray, I'll highlight them right here. Those categories in gray, you don't want to mess with those unless you absolutely have to. A lot of those have formulas and they will auto change automatically. The ones in yellow are ones that you totally can change and you should change based upon the deal. And lastly, the ones here in green are going to be your main numbers. So those are the ones that are really going to highlight if the deal is a good or a bad deal, the ones that you should be directing your attention to when analyzing a property. So let's go into Zillow. I have Zillow pulled up here on this other side, and this is Harrisburg, PA. You can choose any property. I'm just choosing a random property. This property has no purpose that I'm choosing it, but if I were to want to see if this is a good deal, this is how I'd go about doing it. So I'd go into my Zillow, I'd see purchase price is 206. We're not going to talk about rehab, but if I were to look at rehab, I'd go through the pictures and see if this property needed a rehab. It's actually in pretty good shape, but you determine, hey, we'll put in a random number today. So we're not really talking about rehab, mainly focusing on the analyzer. So we're going to need to pull off the main numbers here. And so this property is listed for 206,000. So if we were going to purchase it for 206,000, we'd put that there. The rehab budget, we'll just put 10,000. You're going to want to be able to do a little bit more due diligence than just quickly scanning through the pictures on how much you want to spend on your rehab. You either can find rental comps. One way I do that is I actually go over to Zillow and I look around for what's renting, and I'll show you how to do that here in a second. The other way to do it is Zillow often lists right here under estimated market value. So they list a number here, not all the time. So sometimes you have to do a manual, and you probably should do it manual unless you're really good and you know the market really well. But we're just going to use Zillow's for this case scenario, the 1373. And so that would go up here for monthly income, 1373. And then you're going to need to fill in the taxes. I'll go down here, public tax record. You can see, so this is last year, 2,367. So you'd put that there. We have a management fee already in here. Some of you guys might manage your own rental. So we manage our own rental, but I always think it's good to have a 8% management fee in your deal analyzer. And the reason being is for other investors that are looking at your property, they don't always self-manage. A lot of investors use third-party property management. And so that's going to be factored into their number. So I like to factor it in mine to determine if the numbers make sense. Up there, you're going to type in insurance. I usually leave this about $90 now. It might be a little bit cheaper here in PA, but just make sure you make that a minus because that's an expense. And so we'll put $80 for insurance. You have repairs and maintenance and vacancy down here. I have that 5 and 6. You can technically change that, but usually around 10% is pretty standard. And so those are the main numbers that you're going to change. If you have an HOA, you'd put that over here. Ground rent, if you're paying water. So if this is a multifamily building, you might have to pay maybe public utilities, electrical for the public service, the hallways, and you might also have to pay water. You might bill that back to the tenants, but that's what you'd put in utilities. So if this had an HOA, you'd want to put a minus number, and let's say it had a $65 HOA. And so that's what would go in there. This one does not have an HOA. And you'd be able to find if it had HOA, usually it will list it on the facts and features on Zillow down here, and you see it says HOA, no HOA. So with that all said, you can change the interest rate. Let's say you think you're getting a 7% interest rate, or maybe you're getting higher. You can change the interest rate, depending on market conditions, because that's going to change. I have it at 6.75, and also realize that you can buy down points and stuff. There's a way for you to actually get a lower interest rate, but it's going to cost you if you want a lower interest rate. And so if you come down, you can look at down here, just like when we do a market analysis video, a deal day video, you can see that this one is going to be 4.42%. If you were to purchase this property all in cash, your all in cost would be $226,800. And then if you were to refi it, it would be a negative cash flow if you were to refi it at 75%. And this is kind of a silly thing, but I'll note it anyways. You won't be able to refi it at a negative cash flow if you're doing a DSCR loan. But just know that if you had, I usually look at 75% and LTV. So that means you are going to keep 25% of your after repair value in the deal here. So if you were to put 226, if this is what the value of the property after you're all in, so if your all in cost is your after repair value, you're going to leave 25% of that in the deal, which ends up coming out to about 56,000, your down payment, 56,700. And if you were to do that and you had that much amount of money in the deal, you'd end up having a negative 5.19% return because you'd be losing money every month. But the reason I say it's kind of silly is because if you're at a negative cash flow, you're not getting the loan, especially if you're doing a DSCR loan. The other things that I'll note over here, this equity factor thing over here, and this is where maybe you think that property is worth $300,000 if you do fix it up right, or maybe you add a bedroom or a bathroom. Oop, did $3 million. And so you can type in how much your after repair value is, and then you start getting, an ROI on your funds. And so you can see that just with your equity, you get a 32% return. It breaks it out a little bit with your return if you have a loan and then you sell the property, your return if you do all cash on the property. And then up here, this appreciation factor is just something for you to see if, and this on the top, it's without a loan. On the bottom, it's with a loan. So same thing over here with if you purchase all cash, you'd be right here. And basically what this is just trying to identify for you is without a loan, if the property appreciates 1% a year, what does that do to your return? So instead of you getting this 4.42% return, and if your property appreciates 1% a year, so if it appreciates 1% a year, you're going to end up getting a 5.42%. Because a lot of times we don't think about appreciation, but that does factor in. That is something. So if you're buying in a great area that has a lot of demand, you can look at that, and it's a speculative stat, but it's something that you should consider. And the same thing if you have the property without a loan and it appreciates 4% a year over 5 years, this 4.42% is going to go up to 8.42%. And the reason I have this is poor, average, great. This is just saying like great neighborhoods usually appreciate a bit better, and neighborhoods that are poor, a bit rougher, probably appreciate on the lower end. So I kind of give it a rating over here. And same thing, this is with a loan, and this is just for 1 year. What this would do if your property appreciated within 1 year, what that's going to look like. And so if your property appreciated at 4%, then this ROI ends up going to 10.81%. And so it just changes things a little bit because you have equity involved in your picture. Last thing to note is it's also important to factor in, at least for me, your ease of management and location. And usually those are side by side. So if you're in a really amazing location, usually the property is going to be a little bit easier to manage. And also if it's like a townhouse compared to a multifamily building, usually they're going to be the townhouse with one unit is going to be a little bit easier to manage over a multifamily building. So usually I just put red, yellow, green, meaning the worst is red, the best is green. And that's kind of like a stress factor or a mental energy factor. And usually if I'm not sure of the numbers, but these are amazing, it's ease of management is green, and location, it's an amazing location, then that's something that might push me over the edge. But again, that's more of a not a monetary factor, more of this property is going to be more work, or it's going to be super easy. And so that's how you utilize the deal analyzer. The last thing, if you're going and you're don't find Zillow doesn't show monthly rent, you can always come up and you can click in for rents and look around to see what other properties are renting. When you're looking at comps, you always want to look at similar size, similar property types, and similar bedrooms, similar bathrooms. So if that property that we selected, it's right here on Canby Street, if this is a 3-bedroom, 1-bathroom, 1,780 square foot single family house, when I look at comps to figure out how much I'll be able to rent the property for, I want to look at 3-bedroom, 2-bathroom, 1,700 square feet houses. So this is a townhouse. So this one we could rent probably for more because we're a single family house, even though this has more bedrooms, bathrooms. But you got to look around and find properties that are of a similar caliber. So we're getting closer there in size. And sometimes you might not even be able to find them. You also in Zillow can look under the sold, and often it will have rental listing, previous rental listings. Let me see if I can find one real quick to show what properties were rented out for in the past. Doesn't look like I'm seeing any right now. Let me see if I can just switch this around. So here's one right here. This property was probably rented for $2,186. And so sometimes they're under the sold feature in Zillow. I just thought you should know that because sometimes they're hard to find. You can also go on different websites, apartments.com, realtor.com. Sometimes there's other sites that have better rental listings so you can look at comps better, or you can contact your local agent or the A-player agent that you're working with, and you can reach out and say, hey, I'm trying to understand how much this property is going to rent for, and they can run you a rental comparative analysis. So hope that helps. Again, you can download this deal analyzer in the most of our video descriptions on YouTube, and hopefully it will be a resource for you in time to come as it has been for me. And I'll see you guys on another video.